Turn on Do Not Disturb for 30 seconds. Yes, do not disturb. If the world ends while you're watching this video, you'll hear about it later. Trust me. Now, if you're doom scrolling through financial news right now, stop. If you're quote checking your portfolio again, refreshing your brokerage account every 5 minutes to see what happened to your positions, don't. And if you're about to check the silver price one more time, like it's going to apologize for moving violently and politely return to levels that made sense last week, I have news for you. It won't. It's not going back. Because if you open your trading account right now, if you look at current silver prices without understanding what's actually happening beneath those numbers, you'll either panic, you'll make emotional decisions based on fear, or you'll start planning early retirement in the comments section based on greed and fantasy. Do neither. Not until you understand what's actually happening. Not until you comprehend the market structure breaking in real time. Because this isn't a rally. This isn't silver doing what commodities do when markets get excited. This isn't momentum. This isn't a technical breakout. This isn't safe haven buying alone. This is a stress event, a market structure dislocation, a signal that something fundamental about how silver trades globally is fracturing, which means the chart, the beautiful clean chart showing price going up, is about to lie to you in the most convincing way possible. So don't trust your feelings right now. Don't trust your instincts. Don't trust what looks obvious. Trust the structure. Trust the mechanisms. Trust what the plumbing is revealing. Here's what just printed in the last 24 hours. Before we go any further, welcome to the exposure index. Quick disclaimer, because this matters more than ever when markets are moving this violently. This is not financial advice. This is market structure education and macro analysis, documenting a historic dislocation in global silver markets. I'm not telling you to buy or sell anything. I'm not recommending positions or strategies. I'm not suggesting you speculate on whether this continues or reverses. Do your own research and consult qualified professionals before making any investment decisions. What I am going to do is walk you through exactly what happened, why it matters more than just price appreciation, why the spread between East and West is the real story, and why this might be the beginning of a fundamental repricing rather than just another bull market leg. Now let's talk about today's print. Let's start with hard facts, numbers you can verify, data that's not speculation or projection or wishful thinking. Silver just hit a historic spot record of $93.38 per ounce in Western markets. That's not almost. That's not approaching. That's a confirmed print, an actual transaction price, a level that appeared on trading screens and market data feeds. And the move is violent enough, explosive enough, undeniable enough that even mainstream financial coverage is forced to acknowledge what's happening. Reuters reported silver above $90, up approximately 27% for the year, and we're only in the early weeks of 2026. Over the last year, silver's rise is basically in the realm of how is this real life? Fortune showed it moving from roughly $29 to $86 plus year over year earlier this week. That's not normal commodity behavior. That's not gradual appreciation. That's repricing. That's recognition. That's markets discovering new clearing levels. Gold didn't sit this out either. It didn't remain calm while silver exploded. Spot gold printed an all-time high around $4,639 today. So if you're thinking, okay, metals are up, precious metals are rallying, safe haven demand is driving everything higher, that's a bull market, that's excitement, that's speculation, stop. No, that's not the story. That's not what matters. That's not what changes the game. The story is the split, the divergence, the gap, the part that reveals system stress rather than just market enthusiasm. The part that changes everything about how you should think about what silver is worth. While the West is celebrating the record spot print, while traders and investors and financial media focus on $93 as the headline, another price is screaming from the East. Market trackers, trading desks, and analysts monitoring Asian physical markets have been reporting Shanghai silver around $105 per ounce. 105, not 93, not close to Western spot. 105, implying a premium of roughly $12 over US spot price, 12 full dollars. Now I want to be careful here. I want to be precise about what we can and cannot claim. Shanghai pricing can be shown through multiple instruments, Shanghai futures exchange contracts, Shanghai gold exchange benchmarks, conversions from yuan to dollars using different exchange rates, different timestamps, creating different snapshots. The exact number varies depending on which instrument you're tracking, which conversion rate you're using, which moment you're capturing. But the structure, the fundamental pattern, the relationship between East and West is the real signal. When you have a double-digit spread between major trading hubs for a fungible commodity, for something that should trade at roughly the same price globally after adjusting for transportation and insurance, that is not a normal premium. That is not regional preference. That is not a time zone difference. That is a warning siren. That is a market screaming that something is broken. Because in a functioning market, in a healthy global commodity market with integrated trading and efficient logistics, a spread like that gets deleted by arbitrage, gets eliminated, gets closed fast, within hours if not minutes. And the fact that it isn't being instantly deleted, the fact that this $12 gap persists, the fact that it's sustained rather than immediately collapsing, tells you something ugly, something uncomfortable, something that challenges every assumption about how silver markets work. The bridge is not behaving like a bridge anymore. The mechanism that kept global silver prices unified, that prevented major divergences between regional hubs, that ensured metal flowed efficiently from cheap locations to expensive locations, is failing, is stressed, is showing signs of breaking. Now here's the question every rational person asks when confronted with this data. If New York is trading at $93 and Shanghai is trading at $105, if there's a $12 per ounce gap just sitting there obvious to everyone, the textbook trade is simple. Obvious. Risk-free in theory. Buy silver in the West at 93, move the metal, transport it to Asia, sell in the East at 105, print $12 per ounce profit minus transportation and insurance costs. That's pure arbitrage. That's what markets do. That's what trading desks exist to execute. So why isn't every bank on earth, every global trading house, every hedge fund with commodity desks turning this into a money printing machine? Why isn't capital flooding into this trade? Why isn't the spread compressing as arbitrage capital activates? Because arbitrage isn't a meme. It isn't something that happens automatically just because a price difference exists. Arbitrage is logistics, is operational reality, is the messy, complicated world of actually moving physical metal across borders in size. To close that gap, to execute that trade at scale, you need three things simultaneously. First, metal you can actually source at the indicated price. Not just a paper price on a screen, not just a futures quote, not just a spot reference that dealers show but can't deliver against. Actual physical metal available for sale at $93 in size sufficient to make the trade worthwhile. If you call dealers, if you try to buy significant quantities, you might discover that spot is 93, but premiums over spot have expanded dramatically. That retail coins trade at 98 or 100, that industrial bars in proper form carry premiums, that the all-in cost to acquire deliverable metal is much higher than the spot price suggests. Second, the ability to move it, the logistics, insurance to protect against loss during transportation, financing to fund the purchase before you receive payment from the sale, security to prevent theft, time, because shipping precious metals internationally doesn't happen overnight, customs clearance on both sides, export licenses if applicable, import documentation, all the friction that exists in the real world of physical commodity flows. Third, the ability to deliver into the destination market in the right form. The metal you ship must meet exact purity requirements, form specifications, and good delivery standards that the Shanghai market demands. It must arrive within the time frame that buyers need. It must be acceptable for settlement against whatever contracts or obligations they're fulfilling. When any of those three conditions becomes difficult, uncertain, or costly, arbitrage breaks down. The spread stops acting like free money and starts acting like system friction, like evidence of constraints that prevent normal market mechanisms from functioning. And here's the real-world friction that's making this worse right now, that's contributing to the spread persisting rather than closing: China's export restrictions and licensing system. China's Ministry of Commerce announced that 44 companies will be allowed to export silver for 2026 through 2027. 44 specific companies. Not a blanket ban, not complete prohibition, but a throttle, a controlled valve. Let's talk about a system that doesn't let the market just do its thing. A system that limits and manages what goes out, instead of letting it flow freely. This isn't some small detail, it's structural. When you tighten the export pipe in a market that's already stressed, when you add regulatory hurdles to physical movement, when you make it harder for metal to leave China even when prices outside are lower, that price gap becomes more likely to stick around. It's more likely to get wider. It becomes proof of real-world barriers, not just a temporary supply-demand issue. Now add strong industrial demand to this mix, and the situation gets nasty. It starts feeding on itself. It becomes dangerous for anyone who assumes this price gap will close up quickly. If you're an industrial buyer, a procurement officer at a factory responsible for getting the raw materials to keep production lines running, you don't care about charts. You don't care if silver looks overbought on some technical indicator. You don't care about Fibonacci retracements or moving average crossovers. You care about one thing and one thing only. Can you get the metal delivered on time and to the right specifications? A factory manager doesn't just lose a trade if silver arrives late. They don't take a small financial hit. They lose production. They miss contracts with their customers. They lose revenue. They could even lose their business for good if they can't deliver on their promises. So when procurement teams sense tightness, when they hear rumors about delivery delays, when they see price gaps widening and premiums expanding, their behavior completely changes. The just-in-time inventory system, where you order exactly what you need right when you need it to save on costs, turns into just-in-case stockpiling. It turns into buying ahead of need. It turns into paying more for certainty rather than trying to get the best price. That's how you get buyers who don't flinch at price dips. That's how you get buying pressure that isn't sensitive to price. That's how you get demand that stays strong even when spot prices are hitting levels that would normally scare buyers away. And that's why it matters so much when Shanghai is trading higher. Because that's the market where industrial urgency often gets priced in more directly, where physical settlement is more common than just settling in cash, where the players are more likely to be actual users of the metal, not just financial speculators. When Shanghai pays $12 more than New York, when Asia is willing to buy at 105, while the West is trading at 93, that's not just excitement, that's industrial necessity crashing into supply constraints. Now, let's talk about a signal that chart-focused traders usually ignore, a small detail that reveals real-world stress. The U.S. Mint signaled a pricing review and potential changes for some of its silver collector products because of rapidly rising metal costs. They didn't shut down. They didn't announce a crisis. They just indicated they need to review their pricing because their input costs are exploding. This is important. When an official government program has to pause or reprice its products, it's not absolute proof of a shortage. It's not definitive evidence that the metal is completely unavailable. But it is proof of replacement risk and extreme volatility in the physical market. In simple terms, if you can't price your product with any confidence, because the raw material is jumping 5 or 6% in a single day, because you have no idea what it will cost to replace your inventory tomorrow or next week, you stop the line and you recalibrate. You pause sales, you adjust your pricing. That's what real markets do under stress. That's what happens when paper price volatility smashes into physical operations. Okay, but why now? Why is this happening in January 2026 and not last year or 5 years ago? What changed? What set this all off? Here's the big picture explanation, the combination of factors that created the perfect storm for this explosive price move. First, we have expectations of interest rate cuts combined with a shaky confidence in our institutions. Reuters linked the surge in precious metals to softer inflation data and growing belief that the Federal Reserve will cut rates. Lower interest rates make holding non-yielding assets like silver and gold more attractive compared to cash or bonds. But there's something deeper going on. It's about trust. Trust in central banks and governments to manage the economy without creating huge, unintended problems. Second, geopolitical risk. That same Reuters report points to global uncertainty as another driver, not a specific war or crisis, but a general simmering tension, trade disputes, unstable alliances, the recognition that the stable, rules-based world order we've known for decades is under serious stress. When geopolitical risk rises, when conflict seems more likely, when international cooperation breaks down, hard assets do well. Assets that don't depend on political relationships or institutional stability. Third, tight inventories combined with strong industrial demand. Reuters explicitly mentioned shrinking inventories and robust demand as factors pushing prices up. That's the physical reality underneath all the financial trading. Less metal available, more metal needed. The safety buffers are getting smaller. That's the fuel for the fire. That's what created the environment where prices could explode. But the spread, this $12 gap between the East and the West, is what turns a macro rally into a market structure event. It's what reveals that this isn't just enthusiasm or momentum, it's a fundamental dislocation. Now let S zoom out and understand why this fire keeps burning instead of quickly burning itself out. Silver isn't moving like this in a vacuum. It isn't repricing dramatically while the underlying supply and demand are perfectly balanced. Industry analysts have repeatedly described the silver market as being in a multi-year deficit, meaning we're consuming more than we're producing year after year. The Silver Institute, according to various reports, expects these deficits to continue being an issue well into 2026. You can argue about the exact numbers. Different analysts have different methods and come up with different deficit figures. But the core concept is simple and undeniable. When a market is already tight, when it's already using more than it's producing, when inventories are already falling, the price reaction to any new demand shock gets amplified. It gets magnified. It gets violent. And when you add export controls like China's licensing system for 44 companies, plus growing industrial demand from electrification, solar panels and EVs, plus safe haven demand from geopolitical uncertainty and rate cut expectations, you get the kind of vertical price move that breaks normal trading psychology. It goes beyond what technical analysis predicts. It forces everyone to rethink what price levels are even possible. Now, the precious metals community online loves to repeat one phrase: The banks are trapped. Let's translate that into something real, a mechanism, not just a conspiracy theory. Let's talk about what actually happens mechanically when prices go vertical. When prices spike this aggressively, when silver jumps from $86 to $93 in a flash, anyone with a large short position, a bet that prices would go down, faces severe pressure. They get margin calls. They're forced to put up more money as collateral or close their positions. This creates forced covering, forced buying. The people who bet against silver now have to buy it back to get out of their losing trades. They have to buy regardless of the price. They have to buy even if it means taking huge losses. And in a market where getting your hands on physical metal is getting harder, where the gap between paper price and physical price is widening, where delivery is becoming a question mark, this short covering becomes like gasoline on the fire. It's more buying pressure that pushes prices even higher, which triggers more margin calls, which forces more covering, which pushes prices higher still. I'm not naming any specific bank as a villain. I'm not pointing fingers without solid evidence or claiming a conspiracy. I'm saying the structure itself, the mechanics of leverage, margin, and forced selling, punishes shorts when spreads widen, when physical premiums stay high, and when prices jump like this. And this is exactly the environment where trapped becomes a mechanical description of reality, not just an emotional word. Here's the brutal truth that casual observers often miss. The price of silver isn't a single number, it's not one answer. It becomes a spectrum, a range, a distribution of different prices for different forms of silver and different levels of access. There's the screen price, what you see on charts and financial websites. There's the allocated price, what you pay for specific identifiable bars held for you. There's the retail premium price, what dealers charge over the spot price for coins and small bars. There's the industrial bid price, what manufacturers are willing to pay for large quantities in a form they can actually use. And then there's the emergency procurement price, what you pay when you absolutely must have the metal right now and can't afford to wait. So when someone says silver is $93, when the mainstream media reports that as the price, I always ask, which silver, what form, what level of access, what are the settlement terms? Because the silver you can click to buy in a derivative account, the silver that just gives you price exposure through futures or an ETF, is not the same thing as the silver a factory can secure for delivery next month in the exact quantity and specifications they require. And today's spread, this $12 gap between 93 in New York and 105 in Shanghai, is screaming that difference. It's making the invisible visible. It's revealing the split between paper exposure and physical access. Now, you asked about Peter Schiff. Here's the honest way to frame it without overstating things. Schiff has been loudly bullish on precious metals for a very long time. For years, he has argued that this kind of disconnect between the paper price and the physical reality was not just possible, but inevitable, given the ongoing monetary policies and fundamental supply and demand issues. He sees this kind of price action not as a surprise, but as the long overdue consequence of a system that has been distorted for far too long. You're seeing the headlines everywhere. Mainstream commentators who've been talking about gold for decades are suddenly laser-focused on silver. They're highlighting the price action, pointing out the explosive moves, and bringing massive attention to what's happening in the commodities market. And you know what happens when they start talking? The retail audience wakes up. People who don't normally follow precious metals, everyday folks, start paying attention. And when retail interest surges during a time of physical market stress, when we are already seeing high premiums and wide spreads, things get interesting. But that pressure doesn't just fade away. In fact, it often expands, adding another layer of demand on top of what industrial users and institutional players are already doing. Now, I'm about to say something that might save you from making a huge mistake, something that could prevent an emotional decision based on FOMO or panic. When silver goes vertical like this, when the price spikes violently in a short period, it tends to do two things at once. It rips higher with incredible force, but it also whipsaws brutally. We're talking about sharp, sudden pullbacks and corrections that are designed to shake out the weak hands, force liquidations, and create panic. So yes, expect intense volatility. There will be days or even weeks where silver drops 10 or 15% for no apparent reason. The chart will look like it's breaking down, and anyone who bought near the peak will start to feel foolish. But you have to look past the daily price swings and pay attention to the real signals underneath. If the price dips, but the premiums you pay for physical metal stay high, that's a signal. If the paper spot price falls, but dealers are still charging a significant amount over that price, that's a signal. If the price gap between East and West stays wide even during a correction, and if delivery times for physical silver remain long, that dip is likely just noise from the paper markets. It's financial positioning and derivative markets adjusting, not a true relaxation of the physical supply squeeze. The real-world industrial demand doesn't just disappear because futures contracts had a bad day. So, what should you watch over the next week to know if this is a sustainable new price level or just a temporary spike? I'm going to give you a simple checklist of 5 things that matter more than the daily price chart. First, the spot price itself. Does silver hold its ground above the key breakout levels, or does it completely reverse and fall back to where it started? This tells us whether the market is accepting this new, higher price. Second, watch gold. Does gold stay near its record highs? If gold remains strong, it supports the idea that this is a broad repricing of all precious metals, not just some wild speculation in silver. Third, and this is crucial, the Shanghai premium. Does that price difference between Asia and the West stay in the double digits, or does it shrink back to a normal dollar or two? That spread is the most important structural signal we have right now. Fourth, keep an eye out for any policy signals from major exporting countries like China. Any new rules, export restrictions, or changes to their licensing system can directly impact the physical flow of metal around the world. And fifth, watch the behavior of mints and dealers. Are they pausing sales? Are delivery times getting longer? Are they constantly repricing their products or announcing that certain items are unavailable? These are real-world signs of extreme physical stress. One more thing to watch is how the exchanges react. If they start tightening margin requirements, demanding more collateral to hold a position, it means their own risk managers are getting worried about the volatility. That's a sign of stress, not normalization. If these signals, the premiums, the spreads, the availability, all stay tight, then the idea of $100 silver stops sounding like a fantasy. It stops sounding like hype from a few enthusiasts. Even major news outlets like Reuters are reporting that analysts are projecting silver could reach $100. Not because we want it to, but because that's the price that might be needed to ration supply. That's the price level where industrial demand finally gets crushed, forcing users to find substitutes and bringing the market back into balance. Now, I have a question for you, and I want you to comment with just one phrase. Either spread closes or spread widens. Your answer tells me a lot about how you see this market. Do you think the financial bridges are still working, and this price gap will snap back to normal? Or are we entering a new reality, a two-price world where silver in the East and silver in the West are treated as fundamentally different assets? If you think the spread closes, you believe this is a temporary glitch. If you think the spread widens, you understand that something structural is breaking. Let me give you the simplest, truest statement about what determines real value. The real price is the price that gets the metal delivered. It's not the number on a chart, not the headline-grabbing figure, not the spot price everyone quotes. It is the price that actually clears the metal, the price where physical silver changes hands from seller to buyer. And when Asia is printing a much higher clearing price, when Shanghai shows that $105 is where metal is actually moving, then Western markets have only 2 choices. They can chase that price higher, acknowledging that their old price was too low. Or they can become irrelevant, just a paper derivative market, disconnected from physical reality. So yes, silver hit $93 in Western markets. Yes, gold hit a new all-time high. And yes, Shanghai is reportedly trading around $105, a massive premium over the US's spot price. The exact numbers will fluctuate, but the message is crystal clear. When spreads blow out to double digits and stay there, the market is sending a warning. It's telling you that the fundamental assumptions about how silver trades globally are breaking down. We don't need to guess what happens next. We monitor. We track the signals that matter, the spreads, the premiums, the delivery times. We are here to sound the alarm when the market structure shows this much stress. Like this video, subscribe to the channel and comment silver to let me know you're watching this historic repricing unfold with us. I'll see you in the next update.